Hello, everyone. Welcome to the third episode of Tech Behind It, a podcast powered by Yabex, a digital lending solution simplifying financial services in the new markets of Africa, Asia, and Latin America. So, today I have a very special guest with me. He's the CEO of INM Bank, Mr. Zahid Mustafa. INM Bank is one of the leading financial institutions of East Africa, and I'm very excited to have you as a part of the show today. Thank you so much for joining. And how are you doing?
I am good, and thanks a lot for having me here.
So usually I get into the podcast with serious questions directly, but with you, I'd like to start in a different way. I would like to know a little bit more about you, about your life up till now, what led up to you become the CEO of INM Bank. So yeah.
Okay. So I'm 55 years old, so it's going to be a very long story. So we might be staying here for long. But anyway, to cut the long story short, from a professional perspective, I did my chemical engineering way back. And then I worked as an engineer for a few years. Decided to go into management, so decided to go and do MBA, where I was exposed to the financial industry. And one of the concepts that you learn in finance is sunk costs. So I treated my engineering as a sunk cost, and I was very much interested in the financial industry. So I moved on and started working for banks. I started off with the Citigroup, where I worked for a good 14 years, mostly in the consumer banking space. I started off in Pakistan, where I'm from. My last few roles, I was working for Citigroup in Czech Republic, Hungary, Poland. These were my markets.
Okay.
Mostly on the payment side and credit card side. That's what I was doing. Then I moved on and I worked for Barclays for the next 12, 14 years. Again, in the consumer banking space, I started off in Egypt, then came to Kenya, worked in Kenya, Tanzania, Uganda, Ghana. My last role was based out of Mauritius. And from there onward, I went back home for a couple of years, and now I'm here in Tanzania with INM. So the main reason to kind of go into a bit of detail around the professional career is that I've been exposed to multiple markets, having worked in Asia, in Eastern Europe, then Middle East and Africa. One thing that you really enjoy are the similarities. Yeah, a lot of people focus on the differences of various areas. I have a passion of looking at the similarities, especially when it comes to customer needs, customer buying behavior. So that's what is very interesting to me, and I try to apply the learnings of one markets into the other markets.
So that was a very interesting answer, actually. So you being a part of the banking industry, so holistically, I would say, and now at this point of time, especially in Africa, what I find very interesting is that many non-banking lenders are coming up in the space. So because of the context of Africa, where there's a huge gap between the people who can actually access finances and the banks who can actually provide finances to those people, the onset of such non-banking lenders who are now bridging the gap, what do you think is the role of a bank at this point of time in Africa? And how is it going to shape the future of Africa, given that you're outsourcing one of the main functions of a bank, which is lending?
Okay, so again, I'll kind of give a little bit of background and history and then come to the main question that you are asking. So obviously, banking has been around for years. One of my previous employer they had been into banking business for over 300 years. And if you really look at that 300-year period, while obviously there's innovation and things have changed over the last 300 years or so, but some of the core principles of banking remained very static. So if you talk about the distribution structure, it was the branch. Yes, earlier on you were doing transactions on registers and paper, and then technology came in and some of the transactions were digitized. And then later on, there were some let's say what we call as the market evolved, your internet and mobile banking solutions, all of those came in. But at the same time, in addition of the time change or the time as a variable, the other thing that has changed around the world is the population. So we've got 7 billion people or more than that in the world now. And trying to solve or serve that a big volume of customers in the similar distribution channel is not going to happen. So that, I think, has led to a need of a change. I still remember working for Citigroup. This is now around, I would say, 2002 or 3. There was a change in the management. At that time, I think the world population was around 4.5 or 5 billion people. And one of the senior banker talked about Citigroup having 1 billion customers. And we all thought that this guy is smoking something because in those day and age, you had a very specific definition of a customer, of who is a banking customer or who could be a customer for Citigroup. And mostly these people will be on the higher end of a pyramid. But I think this guy later on, he was not really that successful with the group and left very soon. But I think history has proven him to be correct. So when he was talking about 1 billion customers for Citigroup, he was not necessarily talking about a conventional customer who will walk into the branch, who will have either huge deposits or will have credibility to take a big loan from Citigroup. So the idea was that the world is changing, the population is growing. With technology, the overall world is much more connected than before. So the bankers needed to change the way they were dealing with the customers. But for one reason or the other, I think we all were sleeping on our job. The same was true for payment industry. So there were some working models around your Visa and MasterCard and your schemes, and they were working, and there was not much innovation. Yeah? So the main innovation was that, okay, you have got a plastic card, let's change the color of it, come up with fancy metal names and everything. But the core proposition was not really changing. So that, I think, whenever the existing players are sleeping on their jobs and they're not doing innovation, there will be somebody who will come and disturb the equilibrium of the industry. And that's what happened. It has happened in front of my eyes, and I hold myself as much responsible of missing out on the opportunity as some of my other colleagues. And the first reaction was denial, that these fintech people, these MNOs, they don't know what they're doing about, they lose their shirt in the process. And we know how to do this business, especially the lending business. And rest is history. So we started losing out on customer revenues. Maybe we did not really miss out on a customer entirely, but there was leakage of income made in terms of payments. So bill payments probably was the first product that moved on from us to some of the fintech solutions. And then later on, these small nano loans or lending started coming in. But the bigger loss I think we had was that we did not take advantage of this mushrooming or growing population. So while we retained onto our customers, lost some of the revenues on the top of the pyramid, but we were not fit to serve the masses. So some of the banks tried to solve it by putting up brick and mortar, which came in at a very high cost. Some of the other banks which were, let's say, more aware of the costs, looked at that segment from a cost revenue perspective and decided not to go after it because serving them on the conventional infrastructure was too expensive. So some of the people ignored it on the account of it not being profitable. Others went in and not necessarily made money. But the real solution was technology. Okay, so after the denial period where we considered them as novice and they will fail out, the next stage I think was where we said that, okay, these guys are doing a good job. So let's try to compete with them.
Mm.
And that is when a lot of investment happened in technology, and the banks said that, okay, let me create a parallel structure, maybe mobile banking, your USSD banking and everything, and try to take these guys on. and a lot of the banks were pretty successful in doing that. The solutions were more robust. The bankers knew how to assess the credit criteria. The thing where this second phase failed was on scaling. So since we were old bankers with the old kind of way of thinking, and more importantly, with under highly regulated environment, so we couldn't really scale up this solution. It's not that we could not understand the need at this stage or make it profitable with the new technology, reducing the cost and increasing the volume. It was that we were unable to scale the business up. And that is when the next phase came in, where the banks realized that number one, the innovation is happening at a very fast pace. And number two, there are things that you are better off dealing with in terms of partnerships. So that is where the partnership kind of phase started, which exists even now. And I think for foreseeable future, it's going to be like this, where rather than trying to capture the entire value from the customer, the banks should be prepared to share it with partners, maybe the technology provider or the MNO platform who's owning the customer. So that's the phase that we are in.
But what I was also thinking about is banks can potentially still do higher ticket loans, even doesn't matter how many, I mean, maybe in the next 10 years, even fintechs can do that. But the low ticket loans that fintechs are giving away out in the market to risky profiles, and without the supervision of a bank, do you think this is good for the long term, or do you think it might backfire?
So the challenge around mass market is that you've got very limited information.
Yeah.
So I still remember when I first got into this business some 6-7 years ago, I was mostly comparing it with conventional consumer banking loan. So, conventional consumer banking loan may be a credit card, a mortgage, personal loan, auto loan, or whatever it is. You are basically determining or assessing the capacity of the borrower. Okay, and in most of the cases, if it is a salaried employee, you're basically looking at the salaried variables. You have a good understanding looking at your portfolio that if the income cutoff is so much, $1,000, this is the kind of customer profile. As you go down the pyramid, the risk increases. So those were the models. And getting into this kind of business, I actually thought that it will be a similar kind of experience. The model that we worked with earlier on had something like, I would say, about 20 variables that you would play around with. We'll start off with some of the demographics like your age and your location where you are living, your dependents, and all of those things, which are very similar to the consumer banking scoring model. The additional information, because we partnered with an MNO, was information around the mobile usage, maybe airtime, mobile money, and things like that. And those kind of we used to put up a scoring model, and we went and we started lending to the business, like many players before us. And the two things which were very exciting about that business, one was, I still remember Citi had a tagline, Citi never sleeps, and we were very excited about it. And we said, and the basis around it was that a Citi customer using a credit card or a debit card can access business 24/7. So Citi never sleeps. You can go and do a transaction 24/7. But when I got into this business, this was really a real-time kind of a business where you're giving credit or assessing people on a 24/7. So it was very exciting for me from that perspective. The second thing that I learned was that information, although you're giving small loans and you've got smaller information, so my idea was that, okay, we've got, let's say, a less complicated or a simple credit assessment model. But since the loans are small, so they will equate. It doesn't work like that. So what we realized was that it's very difficult with the limited information that you have to distinguish or differentiate between a good borrower and a bad borrower. And once you don't know that, then you're basically shooting in the dark. So what we realized was that the biggest determinant of a good customer or bad customer is actually the experience of this person taking a loan and returning it back. So over the years, over the last 6-7 years, I've looked at various models, various players and everything, and the same is true for everybody. So there is some magic that happens when somebody takes a loan of 5 or 6 times and returns the money. Is a much better risk than somebody else who may be having the twice usage of mobile phone, but is not paying back. So it's an element where it is more than capacity. It is the character equivalent that is coming in, where you've taken a loan 4 or 5 times and paid it back. So that is where I think the biggest challenge is, because that is what is the issue around scaling up. Now, there are multiple solutions out there in market, and there are extremes. So there are solutions in the market where you have the entire history of the customer's mobile phone. So which websites he has been to, the Facebook profile, everything. So that is kind of getting into too much details, and you need to really draw a line where it becomes infringement of personal information. But that information is available. I still remember in one of my earlier products, one of the biggest challenge that we had was on a Saturday evening, people borrowing and watching a Premier League match and betting in there and losing out. Okay. So our solution around it was that, okay, let's curtail lending or reduce the loan amounts on a Saturday evening, which is the time where most of the people are taking loans, or limited by age. So whatever variables I had, I could play around with. Some of our competitors who had the entire information on the customers would not give out a loan to somebody who has ever visited using that mobile phone to any betting website. So they had more information around it. But then the question is that what is ethically right and what is ethically not right. So I think that's the issue that we are kind of playing around.
Cool.